Jai Jinendra, and welcome on behalf of myself and Paresh Shah. My apologies, both of our apologies for the late start, as we've had some technical difficulties. The gremlins got the better of us today. So my apologies for the late start, but welcome to you all to the next in our series of presentations that we're making for the Oshwal Financial Education Series. And the latest one, today's one, will be on income options at retirement. This is part of a series of webinars that Paresh and I have been running. And I would like, this is the 7th one of 8. And as you can see, there's one more in October, which I hope you'll also join us for. Next slide, please. We've designed these sessions to educate members of the Oshwal community. As we've said before, we are just giving you a very basic overview of different topics related to financial planning. And if you are requiring any further information or advice, always seek the help or guidance of a qualified professional. Next slide, please. As we've said before, the series of seminars that we've been running has gone down very well. We have received a lot of positive feedback, and it's been a pleasure, obviously, hosting these sessions, and the knowledge that members of our community are finding them very useful as a source of information and learning certain things that people didn't realize or didn't know before they came onto these webinars. So it's been a pleasure doing that. So today's topic is around retirement options, and I'll hand over to Paresh to start this off with the state pension.
Thanks, Vinay. Jai Jinendra Pranam, everyone. Hope you're well. So as Vinay said, 7th of the 8th session, we're looking at pensions today, options at retirement. State pension, one of the most sort of talked about income in lots of places. It's a really good source of income, income paid by the government for national insurance contributions you paid over your working life. The pension, state pension, when you come to your state pension age, you will get a letter about 4 months before that you're entitled to the pension. However, it doesn't get paid out automatically. You must claim it. If you don't claim it, you don't lose it, but you do need to claim it before it starts being paid out. So it obviously look out for those letters that come through the post and make sure that you do claim it. The pension age at the moment is 66, which will rise to 67 and 68 by 2046. There's no guarantee that it will stop there. It may rise quicker or higher than that. As I said earlier, the next slide, please, the pension age is 66. However, the amount of pension you get, it depends on how many years of national insurance contributions you've paid. Now, the pension's general rule is around 35 years of working life. So if you've been working for 35 years, you'll get that. If you've been off work, you will still get national insurance insurance credits, which will entitle you go towards your pension as well. So it's not necessarily if you've not been working, you've been claiming income support or benefit, you will still be able to add pension to your pot. A lot of people will defer their state pension because they have other sources of income, and they may defer it for tax efficiency reasons. And it's a good way of looking at this income and deferring it. And if you defer the pension, you will get a slight increment in your pension. It's not as generous as it used to be. It used to be 10.8%. I think it's around about 5.9% now. for every year that you defer. Now, one of the things we always say to our clients, doesn't matter what age you are, you want to find out how much pension you're likely to get. Go onto the government website and key in your national insurance date of birth and so forth. You will be able to get a forecast of your pension, what you're going to get at state pension. Really useful to know this, because you may be able to fulfill some of the fill any gaps that you may have. You can go back 6 years and add extra national insurance contribution, so you can fill in those years that you missed out on. So it's ideally, what used to call BR19, now you can go on the website and get the forecast, state pension forecast, and we always urge you to get it, so at least you know what you're going to get. So that's enough on state pension, but it's worth looking at. Over to Vinay.
Thank you. So most people will build up a personal pension of some form from when they are working and throughout their working life. And it's basically built up on a percentage of your earnings being contributed into a pension, and the employer normally contributes something towards that as well. As most of you probably are aware, before it wasn't compulsory that your employer had to put you into a pension scheme. However, that's changed with auto enrollment, and now all employers have to put you into a pension scheme unless you decide to opt out, which is something we would thoroughly recommend that you take part in, because any contributions you make and any contributions the employer makes builds up a pot of money for you when you come to retire. It's likely that you may work for more than one employer over your lifetime, so you may well have many pots of money from each employer that you worked for in the past. So a lot of people nowadays don't tend to stay with the same employer for all of their life. People do move around and therefore create little pots of money everywhere, which can become quite difficult to manage. And one of the options that you do have is, if you have a number of pensions, then you may want to look at the opportunity or the options to consolidate them into one place, so that everything is under one roof and it becomes more easy to manage one pot of money than many pots of money. That's something I've noticed with a lot of clients who have moved around. They don't always know where all their pensions are or how much is in each pension, etc. As people do with time, lose track of the pensions and their entitlements, etc. So it's always a good idea to make sure that you have, your documentation, you're aware of all the pots of money that you're entitled to, and as I said, ultimately look at consolidating if it makes sense for you. However, always be aware that this should be done with advice, and there are small caveats and things which may, guarantees and things which may be within your pension, which you would lose if you move them around. So it's always worth seeking advice before you make any sort of a decision around consolidating pensions. As we've said in the past, the personal pension, the earliest age at which you can usually access your pension is 55. However, it's rising to 57 in 2028. So as with the state, to put it in line with the state pension when it gets to 67 effectively. But there's no upper limit to when you can, how long you can leave your pension invested. So you don't have to draw your pension out at 55, and you can leave your pension as long as you want until you're ready to take it at a later date. So always bear that in mind. Something worth thinking about if, when you come to a point when you're thinking about your retirement options, to have a good idea of everything that you're looking to do. The two main types of pensions that are out there are defined benefits. Something like a civil service or a teacher's pension is what we would term as a defined benefit scheme. And Paresh will talk you through the options, etc., and what that means in more detail in a minute. And defined contribution is where you basically build up a pot of money and you buy a personal pension or some sort of income from that. I'll hand over to Paresh to talk you through those two types of pension in more detail.
Thanks. The defined benefits pension scheme is generally known as, or used to be known as, final salary schemes. People who worked in local government, NHS, civil service, or large corporates may have had those final salary schemes. However, they're not so popular nowadays, purely because they're difficult and expensive to fund. And a lot of companies have pension deficits who've started this because pure reason is people are living longer. So they've got to fund those people's retirement. So the general rules of or points of a defined benefit pension scheme, so that provides a guaranteed income for life. So if you're working for NHS, John Lewis, for instance, and you were on final salary and you're taking your benefits, that benefit is guaranteed for life and usually increases in line with inflation or some sort of increases depending on the rules of the scheme. And if something happens to the person, you as the pensioner, your spouse will get 50% of your benefit. So if your pension is £10,000 a year from, say, John Lewis, and something happens to you, it could be up to 50%. Which your spouse will get 5,000 for the rest of their lives. So it's a really good benefit. If you had final salary, they're gold dust. They don't exist in the main now. As we said, always linked to inflation, so that it will always keep pacing with your cost of living. As we said, the cost of these schemes are expensive. So next slide, please. The old rule again is that if you did 40 years of service, you would get a maximum of 2/3 of your final salary at the point of leaving, and that's a very good benefit to have. So if you're on £60,000 a year, when you left your salary employment, you would get 40,000 as pension, and you can take up to 25% as lump sum. Some of you who receive pension benefit statements will say, well, look, you can have this lump sum, or you can have a higher pension. So it's a trade-off. You can have some tax-free lump sum, but you'll have a lower pension ongoing, but it is guaranteed for life. So something that is worth thinking about. Next slide. As Vinay mentioned, defined contribution is exactly what it means. It's based on your contribution, how much you put into the pension pot. That will dictate how much you get at the end. Obviously, along the way, the performance of the investment is quite vital in that. The level of income that you get is not guaranteed. So if you're turning 55 or 60 and you decide you've got a pot of money and you start to take money out of that, the reason it's not guaranteed because we don't know what the underlying investments are going to do over the next few years until you're until you pass away. So it is very much down to the size of the pot, how much you take out, and the performance of your investments. So there's no guarantees on that. But however, there are tools that you can use to see how much you need over the period of time and reduce that amount. One of the things that defined contribution does over the defined benefit schemes is gives you flexible options at retirement. So for instance, if John Lewis said, well, you've retired, your pension age is 65, you've got to take income from that now. Whereas with a defined contribution, you can say, well, I don't need income at the moment. I'm working, I've got other things going on, and I've got enough income from my other investments. I don't need that pension. So you can let it build up. And you can say, well, I'll take it at a certain point in time, or take some of it at a certain point of time. So there's so many more flexibility than they've ever been before. So, next slide, please. So, and this is one single slide because the number of pensions that people have during their lifetime can be, half a dozen, 10, and some people have moved around jobs quite a few times, and they've always accumulated pensions in different places, but nobody seems to change their address as they would for their doctor or anybody else, but they will never inform the life company. And as a result of that, there's a staggering £19 billion worth of pension that's unclaimed. And that's roughly £13,000 per individual in the country. So it's a lot of money that people are not claiming. And the government thinks that in 2050, 2050, they'll have 370. They'll have 50 million dormant pension plans. Now, what that means is that people will have money that they're not using, they're not claiming, they're not actually using wisely. We're always worried about money not doing the best for us. One of my advice, and Vinny will agree, I'm sure, is for you to look after that money and nurture it. Just like in the picture behind me, is if you're planting a seed, you need to plant, water it, look after it for it to grow. And that's what we're doing. Is we were saying, whatever you do, always keep checking your pension. How is it doing? If you don't understand it, speak to an expert, or there's the government website as well. So again, if you have got a pension, you're not sure where it is, look at that website, government.co.uk, find pension contact details, and you will be able to track down your pensions that way. Really?
Thanks, Paresh. I think the other point that I would like to make before I carry on is that the fact that people are now living longer than they did traditionally, the old adage of having a pension at 65 and possibly passing away at 70, 75 days are gone now, and a lot more people are living longer, and therefore the retirement requirements are much broader and need income for longer periods of time. And therefore, how you take your pension and where you take your pension or your income from becomes quite a topic that needs to be really thought about thoroughly, as you don't know how long you will need that money to last potentially, and you wouldn't want to be in a position where at some time in old age your pension money runs out, etc. So again, always seek advice and guidance to make sure that you're making the most of your pension options as well as your other income options. So we were talking about people taking income at retirement, but ultimately, as the slide says there, you don't have to take any money out of your pension. It's not an obligation that you must take your pension at a certain age. If you don't need the income, then you could leave the money to continue growing as it's invested, which ultimately means that when you do take the pension, when you start taking your pension, because you've given it time to grow, it could be a bigger pot of money than you would have done if you'd taken your pension early. And it's remember, it's always growing in a tax-free environment, and therefore it's a very efficient way of accumulating and saving your money. You and your employer can carry on making contributions, I mentioned earlier, up to the age of 75, which is the point at which you do not, therefore, after that point, you don't get tax relief on your pension contributions. And so that's sort of the pivotal age to think about these things. If you don't have any earnings, as we've mentioned previously in some of our webinars, you can still get tax relief, and you can still invest up to £3,600 into a savings pension until the age of 75. So it's not always a case that you may have other source of income and which are not pensionable, and doesn't stop you from continuing making contributions into your pension if you wish. So just bear that in mind. But ultimately, remember that investments do go up, and they certainly do go down as well, as we've seen recently. But it's always about the long term, and you should seek regular advice if you're unsure of your options and how it's doing and where to invest. Next slide, please. Something that's become quite relevant in this day and age is there's a lot of companies out there who are trying to scam people for their pensions, and the government has put a lot of effort into making sure that people are aware that they don't fall foul or become a victim of these pension scams. So just be extra vigilant that if someone approaches you directly regarding your retirement fund, make sure you check credentials, make sure you know who they are, and be aware that people are out there trying to get people to transfer their money to other pension funds and different accounts, etc. And basically, you never see that money again. So it's the old adage that we would say that if it sounds too good to be true, then it probably is. So just do bear that in mind. It is something that, these days with the internet and with telephone contact, etc., people are just trying to scam, people who don't understand, or certainly when you're at an age where maybe you are not so vigilant, they're taking advantage of you. So just bear that in mind. Paresh, next slide, please.
Thanks, Vinay. Yeah, I think the point about scams is quite important. There are a lot of people who've been investing in pensions, into properties and such like, where they literally have lost all the money that they've invested. So it's very important that you check the credentials of the advisor that you're talking with. They must either come from the easiest way is to check on the FCA register, to see if they're a genuine advisor, because that offers you protection that he or she is a regulated advisor and regulated by the FCA. So it's very important to do that. So your option to retirement, this what you do when you've got a lump sum of money. The traditional route used to be that you buy an annuity, or you're looking at income drawdown, which we'll cover in a minute as well, and take lump sum. So I'll cover the annuity part. Next slide, please. So what is an annuity? Annuity is basically offers you a guaranteed sum of money for the rest of your life, generally provided by insurance companies. If you built up a lump sum of £100,000, you can take 25% tax-free lump sum, and the balance you buy an annuity with. Now, the annuity depends on your age, your health as well, and what you want from the annuity. So you may say, look, I've got £75,000 annuity. My health is not so great. So the insurance companies will give you better rates because your life expectancy is shortened. So gives you a slightly better return on that annuity. So 75,000, let me give you an income of, I don't know, it's around 4% maybe for the rest of your life. Now, what happens afterwards is once you've got that annuity, you're guaranteed that income for the rest of your life. However, if something happens to you somewhere down the line, that money is gone. Does not go to your estate. Vinay will cover something about that a little bit later. So it's really important to think about that. In traditionally, again, people who've got pensions, they'll get a letter and they'll say, well, here's you've got your pension built up is £100,000. You can have tax-free, and here's the annuity rate. The insurance company that you're with not necessarily give you the best annuity rate options. So what you want to do is try and shop around. Just next slide, please. So just shop around. You're able to shop around. You can go, if you're with, say, Legal & General, Aviva might be offering you a better rate of annuity returns. But as we said, generally not so popular because of the interest rates are so low that the returns from the annuity aren't as good as they used to be. There are some lucky people out there who've got guaranteed annuity rates. I think Vinay and I were talking yesterday. He's got some clients who've been offered 12%, and that's really a guaranteed annuity rate. This is, it's very hardly heard of nowadays to get a new guaranteed annuity rates. So it's good if you've got those, but look out for those things, and always, we keep saying always seek advice before you make a decision, because easiest thing for you to do is to return that form to the insurance company, sign it, and say, here you go, because you feel you don't understand it. So, there's plenty of help available. There's plenty of free help available by the government pension-wise. So do take advantage of them. And the thing is, if your health is not good, it's called impaired life annuity. You will get better returns on those as well. So if you want to go down the route of annuity, then do shop around. Look at the alternatives as well on there. So next slide. Vinay?
Yeah, so thanks. Yes, as Paresh mentioned, annuity rates of 12% is something that I'm astonished in this day and age, but obviously these contracts were set up many years ago when interest rates and investment returns were much higher, and therefore those sort of guarantees have become really like gold dust and amazing when you've got it, and certainly something to make use of if you're lucky enough to have one of those types of pensions. So income drawdown is another option that you have. So what's happening these days is a lot of people don't fully retire when they get to a certain age. A lot of people maybe do part-time work, carry on working where they are, and draw some pension income with a view to, as time goes on, changing that split between work and pension. And income drawdown is a really flexible way of accessing your pension. So you can draw down the amount of income that you need that suits your requirements as you're going along, which can substantiate, or it can make up any shortfalls you may have in your requirements for income if you decide to reduce your hours of work, for example. The great thing about income drawdown is that whatever amount of money you take out of the pension, think of it really like a savings book. The rest of the money stays invested and it can continue to grow. And therefore, as time goes on, again, that starts to build up again, so that your income in future could even be higher than it is today. Obviously dependent on the way the markets behave and how they work, what the returns they give. So as I mentioned, you can change your income as you need to suit your needs as and when you need it. So very flexible from that perspective. Again, as with all other pensions, you can usually take up to 25% of the amount of your pot as tax-free cash. But be aware that, say, for example, today you have a £100,000 pot. If you draw down your 25% tax-free cash at that point and leave 75,000 invested, even though in 10 years' time it may be worth 150,000, you cannot withdraw any further tax-free cash. The rest has to be taken as a pension. So just be aware and mindful that taking the tax-free cash as soon as possible may not always be the best option for you if you have no requirement for it, or you have no other plans to do anything with that money. Then leaving it invested is always a good idea. The other thing is also the money that you have in your pension pot, it remains invested, as I mentioned earlier. You can choose how it's invested and how much income you take as you go along. Next slide, please. You can also, as we mentioned earlier, take lump sums. So what we mean by that is, as I mentioned, if you think of your pension account like a savings book, you can take lump sum withdrawals from your pension, and you don't have to choose an annuity or drawdown. You can directly go to the provider and ask for a lump sum to be withdrawn. You can keep anything that you don't need to withdraw invested, as we mentioned before, or you can exchange it for an annuity or move into drawdown later on. So that's the options you have for lump sums. Paresh? Next slide, please.
Thanks. So coming back to annuities, there's various types of annuities. The most common ones are level annuities or an increasing income annuity. The differences are, for example, an annuity on £100,000 could be £4,000 a year level. That means that that's what you'll get for the rest of your life, £4,000. But as we know, inflation will eat away at those figures. So you may choose an increasing annuity. An increasing annuity may start at £3,000 because obviously the insurance companies aren't going to give something away for nothing. So they will reduce your initial income and then rise slowly. So it's something that you've got to sit down and work out whether it's, do you want the higher income annuities or do you want to go to increasing annuity? Now, also you can have benefit for your spouse on there built in. So joint life and guaranteed with a guaranteed period. The more you add on option, the less your income that you're going to be offered from the annuity. So if you said £4,000 was simple level annuity, then you add an increasing option, then you add on guaranteed income, then you add spouse's benefit, the level will drop as you go. It's difficult to say how much it will drop. It depends on the annuity rates and the providers, how they're going to look at it. So it's always worth, as we said earlier, shop around, but the annuity could be the best route for you, or it couldn't be. But have a look at the options around. You've got, as Vinay said, drawdown, annuity, and take advice, shop around, take advice, because if you've got these, you've saved up a lot of money over your working life, and it's built up to a nice pot. What you want to do is make sure you're going to get the best return for it, whether it's annuity, drawdown, whatever, but make an informed choice from that. Next slide, please. Is that you, Vinay?
It is, yes. Hi. As you mentioned, drawdown is another option that you do have, and I sort of went into how it works briefly before, but basically you have a choice of where you take your drawdown pension from. If your current provider provides it, some don't, then you can take it from them, or you do have the option to transfer to another pension provider who does offer drawdown if that's something you would like to take advantage of. And as I mentioned before, if you have multiple pensions in different places, it's often possible to put them all into one place with one provider, have one lump sum, and then deal with it all in one way. So it's always good to do that as well. And you can choose the level of income, as I mentioned before. One thing I would say is that you have to think about, as I mentioned, about this pension pot has got to last you a lifetime, and we don't know what that lifetime is. It could be 10 years, 15 years, 30 years. We just don't know. So always remember that the level of income that you take out of your pension drawdown is choose a level of sustainable level of income, because you don't want to be in that position where 15 years down the line or something like that, your pension pot runs out and you are not there for receiving a pension. You won't be receiving a pension thereafter. So just be mindful that the level of income that you take should be sustainable. And again, with guidance, an advisor could help you to work out what that level of sustainability is, depending on how markets do, how your value of your fund increases or decreases, will also have an impact on the amount of income that you can draw. And as I mentioned before, you can invest, choose where you want to invest your money as well. So that's some reasons of flexibility in terms of where you want to invest it later on. Next slide, please. So the lump sums I mentioned earlier, They're also known as UFPLS, which is basically the uncrystallized fund pension lump sum. This is what UFPLS stands for, and you can choose how much you want to take from there, and the rest, as I mentioned, stays invested for the rest of the term. And the one thing I would say is be aware that when you've drawn a lump sum from your pension, then the amount of money that you can invest into a pension does get reduced. So if you remember from previous webinars, we've said that you can invest into a pension up to 40,000 per annum. But once you've started taking a lump sum from your pension, then the contributions have been restricted down to £4,000. It's basically known as your pension allowance, basically money purchase pension allowance. So it's always a good idea to only take the lump sums if you really need them, if you are still intending to carry on putting money into a pension. The reason why the government did that was some very clever people early on started taking lump sums out of it and then basically putting the whole lump sum back again to gain the tax relief that they were entitled to. And therefore the government caught on to this, what people were doing, and decided to make sure that they restricted and stop that sort of practice happening. Next slide, please. Barish. Over to you, Barish.
You're losing your voice, I think.
Yeah, sorry.
So the small pots lump sums, this is where you've got pensions of 10,000 or less. And it may be uneconomical for you to buy an annuity or want to do anything with that because of potential costs involved. So one of the things that you can do is take the £10,000 of 25% of which will be tax-free. The balance will be taxable at your marginal rate. So if you're a basic rate taxpayer, you'll pay 20% tax on the £7,500. So if you're a nil rate, then obviously it's no tax to pay. You will be charged tax, but it will be refunded to you. You can take up to 3 times, so up to £30,000 in total you can take. One of the benefits is that if you have a small pension, you do not need to take advice. Normally when a life insurance company or a provider writes to you that your pension is due for renewal and you think, well, which option did I take? They will not give you advice. They will always say, yes, but you need to take advice from a financial advisor. So here you do not need to take advice. They will allow you to take that without advice. But if you do take it out, remember your future pension contribution will be restricted, as Vinay said earlier. So something to bear in mind. If you have small pots pensioners, some people do, who've they either forgotten or made other provisions in terms of properties they might have bought and not made any pension provisions, may have built up a small pots of pension. So it's worth looking at. So next slide, please. Vinay?
Yeah, if you want me to do it, I'll do that.
Okay, well, go for
carry on with Parish.
Okay, all right. So how's the pension income taxed? It's taxed as normal. So if your income falls within your tax bands, you'll pay 20%, 40%, or 45%, depending on your income. If you are taking withdrawals, as Vinay said earlier, UFPLS, so you've built up a pension pot of £500,000, and you said, well, okay, I'll take it all out. So 100,000 will be taxed tax-free, 300,000 will be taxed at 45% because that's the higher rate tax. So all of that will be taxed. So something to bear in mind when you're doing these things is tax planning. Make sure you plan things properly, and you could end up paying more tax than you need to if you make untimely withdrawals. And this is all about planning to make sure everything falls in line so that you do not pay any more tax than you need to. the pension pot that you built up, it is outside of your inheritance tax. That's one of the most important benefits. So for people they've paid off their mortgage, they've got investments elsewhere, they've got enough income, state pension, but they've got this pension pot of $500,000. They do not need to do anything with it. It could go to their children free of IHT. So that's a really important tax planning tool. If you don't need it, you don't need to touch it. And there's payment on death, tax. So there's no inheritance tax obviously on death. So that's what I want to say on that.
Thanks, Paresh. Just to cover some of the alternatives in terms of the annuities and other things you can do as well, which we've not covered in other parts of our presentation today. There is something that is worth looking into known as fixed term annuities. So as you mentioned earlier, normally an annuity, you purchase it and it provides you with an income for the rest of your life. With a fixed term annuity, you effectively set an amount of date, 5 years or 10 years, where the annuity carries on paying you a fixed amount for that length of term, and thereafter the rest of the fund matures and you can relook at your options again at that point. Definitely a different option that may be worth considering depending on the requirements you have for income. Maybe you might want to, as I say, you may be carrying on working on a part-time basis for another 5 years. So you may think about maybe a fixed term annuity to give you some more income in that time frame. And then at 5 years down the line, your pension matures, you come to a point where you want to fully retire and you have all your options basically open to you again. So that's another consideration that you should have a look at. Investment-linked annuities, as the name suggests, basically they don't provide you with a guaranteed amount of annuity, rather that the income that you receive from them is based on the returns that particular investment does. So really it could be a higher level of income if investment markets do well, and conversely, if markets don't do so well, then obviously the amount of annuity you'd receive would be less than you were anticipating, and it's something that you'd have to continually review in line with how the markets are doing. Drawdown with guarantees is another option where basically it's a hybrid basically, but quite a complex area. It combines guaranteed income and all the flexibilities we've talked about when you're in drawdown. Different products work in different ways, and the guarantees do vary, and it's important to understand all the terms, including all costs involved, etc. Next slide, please. As we mentioned before, transferring your pension is an alternative. Some of the pensions may be in old funds which are not performing as well these days because the providers have changed company to company, and maybe the investment returns you're getting are not as good as they could be getting. And an alternative could be to transfer to a better provider possibly, and have a look at that as an alternative. Recycling tax-free cash, we mentioned this earlier. It is something you has now sort of stopped, if you like, or been restricted by the government. So basically, the reason behind that, as I mentioned, was some very clever people started taking advantage of it, and therefore HMRC thought, no, we're not having that, or not letting you have that, in their wisdom, and stopped it, which is also right. The lifetime allowance is something we've mentioned previously. Remember, in pensions, there is a lifetime allowance of how much money you can have in a pension fund. Currently, it stands at just over £1 million, 1,073,100, and it's now going to stay at that level until April 2026. So if you think you might be affected by the lifetime allowance because your pension fund is possibly going to grow to a higher level, you may be able to protect some of it against the lifetime allowance tax charge, which is basically the charge you pay on the amount of pension that's over and above your lifetime allowance. However, that had to have been done by a certain time previously, and it's something you would have had to elect in already. So it's not so easy to do. It's something that is not readily an option available these days. The loss of means tested benefits. Remember, as soon as you start drawing your pension down, some of the mean tested benefits that you receive potentially could be lost. So it's always a good idea to check to make sure that by drawing down on a pension, you're not actually losing out in other benefits in other ways. So that's something to certainly have a look at. And to find out more about that, I would say you go to the government website, and they've got benefit calculators on there, which will give you some more information as to what will be lost or what would happen if you did this or didn't do this, etc. One other factor to bear in mind is that whilst you're building up a pension, because the pension is in like a trust situation, if unfortunately your finances take a turn for the worst and you have basically debts that you owe to creditors, then as long as you've not drawn your pension down, then the pension is actually protected against being drawn or taken away by creditors. So always be aware if that's something that becomes an unfortunate event in your life happens, etc., then pension may be one of the options that you may elect to start taking some money out of, but also be aware that you would lose some of the protection that you have whilst you've not drawn that pension down. So yeah, just be mindful of that. Paresh.
Thanks, Vinay. So the effect of inflation on income, as we know, inflation will eat away into your money. So if you're receiving £1,000 income this year, next year, in real terms, it would be worth inflation, £1,000 less inflation. So if it's inflation 3%, you will be 3% less in real terms. So I think it does eat away, and you just have to be aware of this. If you're on defined benefit, obviously it doesn't affect you because your benefits will be rising in line with the consumer price index. However, if you're in a defined contribution, this is something to bear in mind when you're thinking about drawing income. If you're thinking of paying £10,000, how much is that likely to sustain you for how long? One of the other things we suggest is think of putting pension into trust. Spousal bypass trust is commonly known as. So if something happens to you, the fund, rather than going to your spouse, it would go into a trust. The benefit of this is that your estate is not increased, because generally, if we think about everything passes from husband to wife or vice versa. So on death, the pension pot would go to your spouse. However, if it is in trust, then it's outside of the estate. Therefore, it's called spousal bypass. So it's bypassing that spouse. So it protects it from IHT as well, and also the spouse can still benefit from that. So it's worth thinking about. There are things to consider. It's not straightforward, but it is worth considering. Many times when we speak to clients, we know they haven't thought about who the beneficiaries should be of their pension. It's always worth putting down who, usually it's the spouse, the main beneficiary. But if you've got children, put them down, and you can put them down in percentage. Say your spouse would get 80%, children would get 20%, or something of that nature. So it's always worth putting that down on there, because if at some point something's happened, then the beneficiaries may not get the pension. However, trustees of the pension would make the decision. So it's not always crystal clear, but this is a simple thing we need to do when we're filling out forms. When you join a pension scheme, when you start a pension plan, always put down the beneficiaries, potential beneficiaries. Again, think about the income you'll need in retirement. How much will you need? Considering you've got state pension, which is, let's say, £8,500, and if we believe the figures, £26,000 is what's needed for an average couple to live on. So think about how much income you'll need on that. Next slide. So the Government Pension Wise Service offers free guidance to everybody. So you can look at the website, talk to them, and they will give you time and give you some unbiased advice. So, and without cost on a telephone. So it's worth considering. Pensionwise.gov.uk. Okay, I think that we're done now. Just going to summarize, Vinay. So I think we've got lots of choices on the pensions. As we've always said, that do look at your options. Do look at what you've got. And Vinay will agree that both of us had clients who've had lots of pots sitting in lots of different places, and they don't know what it's doing and what it states in, whether their performance is performing or not performing. Most people aren't aware of what's in the financial world, so do seek advice, guidance, and look at those pensions. Are they doing what they should be doing? If not, what are the options? And I think one of the things that Vinay mentioned was to seek to potentially consolidate them into one plan, so that you know one place to go to, and your family as well. It's important that if something happens to your family, you know where your assets are. Vinay, do you want to add something?
Yeah, so like we've said in previous episodes, pensions and things like that is sometimes an area which a lot of people don't understand very well. And, it's a minefield and sometimes a bit complex. And sadly, the government, sometimes they talk about pension freedoms and flexibility and all the rest of it. And unfortunately, what they do is make it more and more complicated than it needs to be. So definitely worth seeking advice from someone who understands that marketplace and can give you advice. The biggest thing I would say is look at all your options, consider your requirements for income, as we mentioned before, and the longer term income I'm talking about, as we are all living longer these days. And the requirements for income can stretch 20, 30, 40 years these days. So it's definitely worth making sure that you are comfortable and have enough retirement income from all the sources that you may potentially have. Paresh, I remember you were saying to me about a lost pension. We were having conversation about that.
So I think that's it's important. But you may think you've only done a small amount of service with a company, but one of my clients, they thought that it was not worth looking at. The pension, they only did, they were young when they did this. The pension came up to worth £86,000. So it's always worth going back and thinking where you worked. Did you have a pension? And if you're going back 20, 30 years, you may have been part of a final salary scheme. So it's worth, those are really good benefits to have. And your circumstances may have changed, things may have changed. You may have moved addresses, as we do. People move addresses, get married. So it's worth looking at those. And I think I can't stress enough, because as we said, it's over £19 billion worth of unclaimed money, and that's only going to increase.
Yeah. So if we could take any questions that you have. There is one question I can see online at the moment from Manish Gosrani. He's asking, if I have pensions with 3 companies, can I take 25% from each one?
Manish's simple answer is yes. You can. You can take 25% or more 3, providing they're you just look at the pension, because some of the old style contracts you can get more as well on those, but the current personal pensions is 25%. So yeah, definitely you can take 25% and again convert those into an annuity or a drawdown, whichever your preference or circumstances are. So one of the things, other things, Vinay, was you know, we're talking about pensions at retirement, but I'm sure there's a lot of people who are not retired yet. You know, they've got workplace pension, as you mentioned earlier. They may have their own personal pension schemes. They may be in a SIP, whatever. Have you found that people don't look at their investments very often?
Yeah, it's a sad fact of life. Unfortunately, we set these things up and then 10, 15, 20 years go past and they've not been reviewed or revisited again. You know, you have to understand that the reasons why you may have put it into that particular fund or that particular company at the time may no longer be true. So it's always advisable to review where your money is invested and who it's with, etc., on a regular basis. And that can make a substantial difference as to the end result. So, you know, for example, I've seen pension pots which have, you know, been invested for a number of years with the wrong type of pension fund and have not done very well over the time. They've just stayed literally static because a lot of the charges, etc., eat away at the returns. And then you've got other pension funds which have done really, really well. And the dramatic difference in the end result can be substantial given a 10, 15, 20-year period of investment. So, you know, don't ignore your pensions, I would say, is the biggest thing. And if you're not sure, then, you know, just make sure you speak to someone who can guide you in the right way, I think is really important. I think we've talked about consolidation as well. If it's the right thing, do remember it's not right for everyone. And again, it's very, very important before you consider that option to take advice and seek advice for that.
Another question here from Naina Shah. She's saying, I paid into my pension. Sorry, I paid a pension in my previous job for roughly 2 years, but don't have P60 or any details of that. How can I track it?
Yeah, so as we mentioned before, the government website for lost pensions is probably the best option for you. You may want to speak to the company that you used to work for, potentially if they're still around as well. Even on the basis of your national insurance number, they may well be able to track it as well. So it's always worth a call, assuming that the previous employer is still in business. Obviously, with that's sadly is one of the facts that some employers do, you know, cease to exist and pensions do get lost. But the pension itself won't be lost. It'll just be somewhere else. Someone else will be administrating it. So it's always a good idea to check with the government website, as we mentioned earlier.
I think just going back before we sort of kind of close off, is one of the things, pensions, you know, you and I have been doing this for a while. Pensions back in those days, you had a choice of funds, maybe 3 or 4 funds. Now, the choice of fund is much bigger. So therefore, you've got a wider choice, and it's always worth looking at you know, fund choices.
And I think even following on from that, the other thing is, remember in the old days, 20, 30 years ago, there were plenty of insurance companies that used to offer pensions as well. And as time has gone on, either they've been taken over, they've consolidated, they've you know, been amalgamated into some of these companies which are known as consolidators, and they're not necessarily looking after the funds as well as possibly they should be, because their whole remit of looking after these funds is purely to earn those charges and not necessarily give you the guidance that you need to make sure you're getting a best return possible. So, you know, we've seen a lot of these consolidators come into the marketplace, and big household names have now changed hands many, many times. Again, it causes a lot of confusion. Am I with Norwich Union? Am I with Aviva? Am I with Friends Life? Am I with, you know, whoever it is? The names keep changing. And sadly, you know, people do lose track of their pensions because of things like that. So, you know, it's always a bit of a minefield, but with the right guidance, certainly, you know, we can do our best to sort of track it back and work out where it is, etc., and things like that.
I think Naina's asking what can she do. I guess the company is saying they don't have any record. Now, one thing that sort of crosses my mind is when, depends on how long ago this was, but in the old days, if you did less than 2 years of service, the company refunded you your contributions. And if it falls under that, then maybe you were refunded that. But if it's in the recent past, I get, it's the .gov website. And if you just look at tracking pensions, you should be able to then find out a bit more about where your pension is if you did have a pension. It could be that they may have refunded your contributions, which they tended to do in those if it was a while ago. But I think we're over time today.
Yeah. So I think just to bear in mind, any other questions anyone has, the email address is as always oshwalweb@oshwal.org. So please, if it's after this seminar, you still have some questions, then by all means post those on there. And the next session is the final one. It seems like we this time has flown past the amount of topics we've covered over the last 7 weeks. The next one is on the 22nd of October, sorry, 21st of October, and it's around inheritance tax planning, wills and LPAs, which is now becoming a very hot topic in many people's eyes, purely because of the value of properties and investments and things have grown substantially for a lot of people in the last few years. So we look forward to that topic as the final one of this series. And as always, Paresh, I'm sure you'll agree with me, feedback is always a gift. So anyone, all the comments we've had, we appreciate those, but please keep those coming in. Paresh and I are not, speakers by profession, and we've tried our best to cover all the topics in a way that's hopefully been simple and easy to follow. Anything else you want to add, Paresh, before we close?
I think, you're right. I think, we're not professional speakers, but we've tried. And hopefully, it's been helpful to people. But like you said, next week, lasting powers of attorney and wills, we'll cover. But it's important that we all think about financial planning. But thank you all for joining us today. And as always, I keep forgetting to thank the people at the behind the scenes supporting Hemal and Nikunja. Thank you guys for always being there, for helping us out. We had a slight issue today, but glad we got it sorted just before we went live. So thank you very much, and good night.
Have a good evening, everyone. Thank you.